Learn Accounting Podcast by Professor Accounting, Episode 19, International Accounting Standards, IAS Examples. So I thought I'd just give you some examples regarding the IAS in terms of revision. 2 questions here, just for you to see what you've learned in terms of IAS, and hopefully if there's students who are really not sure of this topic, pick up something from these examples and try and relate these to the IASs that you need to know. So the first what I want to do is, first of all, if you can see the 2 questions on the screen, the questions are actually there as well. I'd like two approaches here. You can either look at the questions now and try them yourself, completely try them yourself, pause the podcast, and then rejoin the podcast and check your answers, or you can just leave it the podcast running and watch it with me as I go through them. So again, it's your choice. So hopefully either type, either preference, you can find it of benefit. So what I do in the question one, quite straightforward, is just a recall. It's just recalling the IAS to the course, to the content there, the title. So the description of the IAS. I've put them in some particular order, a couple of easy ones to start off with. But certainly I've tried to link them in some way to give some meaning and some connection. So let's start off with the first one. Statement of cash flow. This is the only one you need to know in relatively high amount of detail. So the first one is IAS 7. Inventories is IAS 2. Presentation of financial statements. That's IAS 1. The accounting policies, changes in accounting estimates and errors, so on. That is IAS 8. Intangible assets. I think we'll look at some examples, but your goodwill, you obviously brands, trademarks, and so on. That's IAS 38. We've got events after the reporting period, so after the financial year. What's that going to be? It is IAS 10. PPE, nice one. PPE is a nice one because you can get a PPE question in the exam as well, which is just related to cost, stack, dep, and BV. That's IAS 16. Impairment of assets. So again, what's this impairment mean? We'll come on to the examples. This is IAS 36. Revenue, interesting one, half of impairment, so IAS 18. Provision, contingent liabilities and contingent assets, a lot there. Well, there's only one left. You've got 30, 36, so it must be 37. It is IAS 37. So again, why have we done it in this order? So again, you need to learn these in whatever way you can learn them. Use look, cover, say. It's a very useful skill. Look at it, cover it up, and then say it and write it if you want. Use all your senses. But you just got to be able to learn the number to the name, and there's no best way of doing it than just practice. With IAS 7, you've got to know this because, in fact, if you're asked to do a cash flows, I think they have to tell you to IAS 7 standards rather than the previous FRS standards. So IAS 2 is quite common. So these two I think are very straightforward. The first one being the statement. So I think you could easily learn these 3. The accounting policies, which is 8. This one I've put there because it relates to the statements. This is the concepts. The policies are the concepts. Any changes or errors that the business makes that gets maybe flagged by the auditors or by an internal auditor, then obviously that relates to the statements as well. So I've just put them together. Intangible assets, good with branding, just that's there. Events after the reporting period. Again, that's looking at. Typically, that looks at dividends. Is a good example for dividends when it's proposed dividends. That's a good example. IAS 10. PPE, that relates to all non-current assets. And a kind of a subtopic for that is impairment assets. We'll look at an example of impairment. What does it mean by impairment? So you're looking at impairment losses. So it's basically it's a loss of value, net book value, the carrying amount, compared to the recoverable amount. I'll show you an example on that, but it's an impairment of assets. So that relates, 16 to 36 relates revenues. Again, so how do we determine revenues? What can be classed as revenues? And when can we recognise revenues? That's IAS 18. So the main example I use for that, I haven't got it in here. I don't think I've got it in here. Yes, I have got it in there. Let's have a look. This one, yes, I have. So the main example I've got for revenues is actually going to be in this question too. So I'll leave it for when we do that. Hopefully useful. Provisions, contingent liabilities, and so on. Contingent assets is IAS 37. So this is provisions. This is like making provision. In A2, you've got it's not depending if you've done module 4 yet. You've got provision for unrealised profits. So you may not know what that is yet. You've got provision for delta debts. So anything like that is any provision provision for depreciation, yeah. So any provisions would obviously be examples for IAS 7. So let's look at some examples then. A couple of them you may see in here anyway. So here's 14 situations, and I want to now use the numbers, so you can use this left page to help yourself. You may know the name, but you need to know the number as well. I'm just going to put the number over here because you can see the names over on the left. So IAS, going to go in the far column. So purchased a brand name. Purchase price are to be amortized. So just remind yourself what amortize means. I mean, a brand name. Amortize is the different word for depreciation, and I say different because I don't want to give it away. This is depreciation relating to intangible assets. So a brand is it, but it's intangible. You can't touch the brand. Whereas fixed assets are tangible because you can touch those. So a brand name is intangible. So the only intangible IAS is, where's it on the list, is the IAS 38. So your answer is IAS 38. The published accounts include a statement of change in equity. So that's all about, the keyword is including. So the published accounts is the presentation, and it's including a particular document because it has to. So in terms of presentation, that will be IAS 1. Okay. Third one, proposed dividends. Okay. I've been shown as a note to the accounts. So just briefly mention proposed dividends. Proposed dividends are at the end of the year. In terms of, it could be the end of the interim period. The shareholders are proposing a certain dividend to be paid at a later date. So if we propose to pay X amount of pence per share, we can't determine whether we can or not until we know the profit we've made. So any proposed dividends are they're not legally binding until a certain stage. So it was said to put these as a current liability in the past. And if you look at exam papers in the past, old papers, you will see proposed dividends. Now in accounting, you cannot put proposed dividends as a liability. It's really odd if you see them there now, because even if they've been agreed by the directors. Between the directors and the shareholders, even if the dividend has been agreed that will be paid, that the amount proposed will be paid, not has been paid, will be paid. So proposed is I plan to pay you, has paid them is obvious, but will pay means that it's been agreed. Then yes, it's a liability. But the point is the time has passed, because the liability would then be risen, it will be created after the report period. So after the end of the balance sheet date that it should have gone into. So you can't put them in at all. Obviously you can put them in. You can put them in the following year's balance sheet, but you're going to have paid them by the time you've produced the balance sheet. So it's a whole mixture of circles in terms of doing that. So very interesting. I look at the dividends. But let's get back to the actual point of it. So for dividends, you need to know about those. If they've been shown as a note to the account, then that is what they are now, how they're now presented. They go as a note to their financial statements. So if they're a note to the financial statements, then it's all about, in this case, timing. They cannot come to liability because they're not agreed until a later stage. So it's all about events after the reporting period. I hope that kind of was drawn out from that example. It's past the reporting period. So the end of, let's say December, end of December is when the balance sheet will be produced. For example, the proposed dividends may not be agreed until the annual general meeting. Until 3 months later or so on. So in that case, you can't put a liability into the current liabilities in the balance sheet in December when they haven't been agreed, and they won't be agreed until 3 months later or so. So that's now the reason behind that. Very important you know that. Four concepts: going concern, accruals, consistency, and materiality. Concepts you need to know from AS. Again, look at those in terms of what they mean and how you can understand and distinguish between them. They've been applied in preparing the financial statements. Now this one is probably, it is an interesting one. This one you can have, I would say you can have two solid examples, so two firm examples for this one. So first of all, this is in terms of the concepts. Of the four concepts, you are using these to prepare the document. So like in number 2, you're preparing something, you're providing what needs to be provided. So it's all about presentation. So you can have, first of all, you can have IAS 1. So that'll be IAS 1, it shows up. But what other one can you have? There is another one as well that's acceptable. Well, it's about concepts. So these particular concepts, they are relating to what's called accounting policies. So they are the policies. The concepts are broadly speaking the accounting concepts. So the accounting policies is over here. That's IAS 8. So you can have IAS 8 as well for that one. Okay. 5. It has been decided to create a provision for doubtful debts. We all know what that is, so we should know what that is. Provision. Also, it is kind of emphasised to now call this an allowance for doubtful debts. But I think it's frowned upon a little bit because it takes away the key word, which is provision. And the key word is provision because which accounting accounting standard has provision in it? There it is. It's IAS 37. So that is IAS 37 to create a provision for doubtful debts. So we know what it is. A lot of this is quite basic. I find these are quite basic. It's just you have to now relate it to get the standard. Next one, the value of some plant. So that's what's plant. Plant it's a non-current asset. Has been reassessed. Keyword reassessed at the financial year end, and it's been reduced in value and shown on the balance sheet at its recoverable amount. So this one, number 6, brilliant example, number 6. Reassessed is a key word. Reduced in value is another key phrase. And a recoverable amount. All phrases that you must learn, and you must learn it for which accounting concept? Which I keep saying concept. Which accounting standard? This was all to do with impairment. So this, for breakdown, this is IAS 36. I'll go do an example after this on this one because it's such an interesting topic. This an interesting standard. But the reassessment is at the end of the financial year when the balance sheet is prepared, or the statement of financial position when it's prepared. Although you're depreciating to be prudent, you are still gauging whether the net book value is a fair value. Is it a fair value in terms of reflecting the market value, or is it overstated? Maybe it's understated. Maybe it's actually too low. Rarely will that be the case, but it might be overstated. Even if you're depreciating, you may not be depreciating enough, even though you might be using the correct or appropriate, should I say, depreciation method. So if there is a discrepancy between the market value and your net book value, then the value, that's why it's saying there's been a reduction in value, and it's been to the recoverable amount. So the recoverable amount is the expected amount you can that you believe you would be able to get for that fixed asset. So if the recoverable amount is lower than the net book value you are declaring on the balance sheet, then you have incurred an impairment loss. An impairment loss must be shown in expenses in the P&L. Again, I'll mention that in another podcast, but also a little example next. 7. Some inventory has been reduced in value to the net realisable value because this value is less than cost. I think it's an easy one. Yes, keyword inventories. So it's IAS 2. Inventories. Look for the keyword stock. They don't use stock now. They use inventories in stock. But if inventories is used, typically that will be the IAS. Okay, all non-current assets have been valued at cost. Obviously, we value these. I know we're looking at net book value. They should be entered at cost in the accounts, but when we say valued at cost, I mean then under there should be valued at NBV, which is taking account depreciation. But what is it looking for? This is looking for basically the whole standard that looks at value of non-current assets, and it's all non-current assets. So that must be PPE. So IAS 16. PPE, call it brief, but again, if you have to write it in full. The financial statements include information about receivables. Remind me, you said what that is, debtors or creditors, for a previous period, detailing the original amount shown, and a corrected figure. It's an interesting element, this. This is, what this is showing you, this is a reproduction of information, and it's showing the original amount and a corrected figure. So what does that imply about the original amount? Well, that it was wrong, that there was an error. So from that, they don't say it. It's too obvious if they say errors. I mean, inventories is pretty straightforward because you've got that. But this one, they can't be that obvious. We can't be that obvious into saying detailed error, because as soon as you see the word error, then you go over to here and you see there's error. So IAS 8 is what we're looking for there. if I find it. There it is. Right. So just for number 9 there, it's if there was an error, then I mean it's rare that errors. I know we're human, but it's rare errors happen because of all the processing and checking in the accounting. But on occasions it does happen. So we have to state the value that is wrong, because we have to represent that, and then we have to show the correct value next to it. We can't just change the value and put a new value, because we have to raise the error. We have to acknowledge that there was an error there. 10. I like 10. Very interesting. The realization concept. Again, AS. You need to learn the concept for realization. I should have mentioned it. It's been applied in the recognition of a sale of goods. So good again that we're selling of goods. We're not buying goods in this example. So realization concept is to realize this is income in this case, because it's still a good. There comes a point in time when there's certain conditions when you can realize a sale. So the example I always use is if someone buys, or should I say we sell something, so a debtor, for example, is buying from our business, and they buy on a sale or return basis. That's the example I use. If they buy on credit normally and become a debtor, then they have X amount of time to pay. If they buy for cash, they have no time to pay because they've already paid. But a sale or return is an interesting example. It means that there is a time period in which the debtor, they are still a debtor to the business, they have a certain amount of time to either inform the business that they are keeping the product or the good that they buy, or they are sending it back. So the consumer, the buyer, has to acknowledge to the business whether they are or are not keeping the product. And if they don't acknowledge after, say, a period of time, I mean, say 10, 12 days or 30 days, whatever they decide, if they don't acknowledge that they are or are not, then it means they are keeping it. So it's a cut-off point. So that means after that period, and it's not always after that period, it's either after the period agreed or prior to the end of the period, as long as the buyer has acknowledged that they intend to keep the product. That's the only two conditions where the business company can recognize, can acknowledge, and therefore we mean realize, a sale. So we can, in that case, recognize what? We can recognize the income, recognize the revenue. So if it's recognition of revenue because of sale, then the only one that's got revenue in the title is IAS 18, which is there. So IAS 18. Very nice example. You've got to know the realization concept quite well there before you can ever consider IAS 18. Comparative information. So that's information side by side. Think of ratios, for example. As off the top of your head, a ratio. You've got this year's ratio and you've got last year's ratio. So you can compare side by side. So from previous time periods has been shown in financial statements. So again, financial statements mentioned, well, it's just all about the way in which this information is presented. If you put information side by side in one column and then more information in another column with maybe dates at the top, it's all about presentation. So that would be also AS1. It's not mentioning like in number 9, where it's saying it's two pieces of information which is detail the original number figure and the correct figure. It's not mentioning something like that, even though it's two pieces of information. This is just comparative. So it's similar information relating to the same thing, but it's all purely for presentational purposes for stakeholders, any investor or shareholder that is wanting to compare and contrast information. Okay, 11. 12 now. A financial statement has been prepared which shows the net cash flow from investing activities. So that's obviously producing what? It's a financial statement. Well, what is the statement that's going to be produced to show net cash flow from investing activities? Well, it's got to be cash flow, hasn't it? So that's IAS 7. So for 12, 7. It's not IAS 1. I know it's presentation. I mean, he could say, okay, you could argue it's only a little statement, but it's a financial statement. But you're showing a particular element of an account. So it's all the rules of IAS 7, which is because IAS 7 is not necessarily the way in which you complete the well, it is in a way completion of it, but it's more the structure, it's more the document, so the pro forma, the layout. So if you have to produce that, I would go for IAS 7 more than IAS 1, but IAS 7 is what it really wants to acknowledge where it goes. 13. Only dividends paid during the financial year have been shown in the financial statements. So again, put this one in there. It relates to Which other one? Well, there's another dividend up here. See number 3? So proposed dividends. So this one is interesting. How does it relate to number 3? 3 was events after the report period, which is IAS 10. This one, what is this one getting at? This is only dividends paid during the financial year have been shown in the financial statements. So again, the financial statement I'm referring to. This is if you pay a dividend, then that transaction is obviously you're decreasing profits, capital, and you're decreasing assets of bank money because you're paying a dividend. So that is a recognised transaction. So that would go into the financial statements, and it's basically what it's getting at here is it's only the dividends paid. So it's all about the presentation. I mean, it's dividends paid, so you might think it's cash flow, so you might think IAS 7. But it's basically getting onto only dividends paid. So it's getting you to think about we don't include what don't we include? We don't include proposed dividends because they haven't been agreed yet. So the key phrase there, I think, is only. Only dividends paid have been included because the presentation element of IAS 1 acknowledges that only dividends paid can be recorded in the balance sheet, profit and loss, and so on. 14, last one. No record has been made for internally developed computer software. So clues for this one. If you develop software, then it's unique. Maybe it's a unique piece of software. It's your design. It's your work. The business's work. I mean, when I say your, it's what you own. It's what you've created. So it might be worth money. It might obviously it's maybe copyrighted and patented. It might be again. So all them clues. What am I getting at? It's if you develop your own software that is potentially worth money to sale, the sellable value, then it's an asset, and it's not something you can touch. So it's not tangible. So it's intangible. So this is intangible assets. This is an intangible asset. So which number IAS is intangible assets? Intangible assets are IAS 38. Now, one little comment about this one. It's still, but a key point to raise here is look at what is being said. No record has been made for internally developed, and that's absolutely correct. You do not record this as an intangible asset in the balance sheet. It cannot be recognised as an intangible asset because it's internally developed, and it's too subjective. If the business decides that they've created something and it has value, then that's okay. But it's how they report that into the accounts of the company. The only, if you wish, intangible asset that can be recorded is external goodwill, which is purchased. So if they were to actually, if you think about this, if they were to actually make this software and then sell it for a profit, then wonderful. They can do that, but how would it then be recorded into the balance sheet? Well, it wouldn't, would it? Because they don't own it anymore. But who would own it? Well, the buyer. Whoever's bought it can now recognise that as intangible because they've purchased goodwill. They purchase external goodwill. An example I use there is employees. When you hear the phrase of you are a valuable asset to the business, when we say to an employee, well, it's interesting from an accounting point of view is employees are not assets. You don't actually own them, so it's quite ironic. But in an example like that is they are so important to you that no, and they probably are. If they are the ones working as hard as they do, as a massive team working very hard, and they genuinely do bring in lots and lots of money, you still can't attribute an amount of money to intangible assets for your employees because you've got no idea, no way of calculating that. And again, I go back to the first reason is that you don't own the employees, so they cannot be an asset. You can have things like if you've got a good client base, if you've got future customers, future strong revenue streams, and you kind of consistent income, then that is obviously something useful to your business. So it is goodwill. But if you look at it in partnership accounting, you can only create goodwill when you have an emission of a partner. all the questions you get, then the goodwill is written off. And it will always be that, because you cannot keep goodwill into the balance sheet, into the books, because it's internally generated. So that's the only reason you do it. Okay, that's 14. I was going to finish there, but I do have 4 that I used from it's from the exam board, with just I'll just comment upon this. There's the full list, and it'll preview the full list. He's the first one. So it's just the answers are going to be on the screen next. What is IAS? What is IAS, and then the name as well. I just put these on because they're a bit longer, and also some of them you can do some calculations, but I'm not gonna. They're not asking for the calculations. I'll just discuss this with you and kind of pick out some key phrases, keywords, to try and help you pinpoint which IAS it might be. So the company spent 15 million establishing the brand name Best. A lot of money. The financial director plans to include the brand name as an intangible asset on the balance sheet, and it'll be amortized over the next 5 years. Well, first of all, it's a lot of money, but this is an internal generated brand, so it can only go on the balance sheet if it was if it's purchased. So if this business, this company, if they bought the brand Grodbest, so it's like the other example I mentioned, if they bought the brand Grodbest from some company, someone else, for 15 million, they can put it on the balance sheet. But it says the company has spent establishing the brand. So it's not asking for this, but the way I understand the language there is as if they have just built up the brand, spent money, injected money into branding, marketing. So they have created the brand, and they obviously think it's worth spending 15 million on, because they have done, but it probably is worth a lot more. But it's internally generated, so you cannot put it on your balance sheet. If they sell it to another business, and therefore that business is buying it, then that business buying can then put it on their balance sheet for whatever they bought it for. So an interesting discussion point. And yes, it's got to be amortized because it has to be depreciated. They do lose value. Brands lose value, just like fixed assets. IAS 38, we knew that. 2. Grodlin plc purchased a delivery van, including the PPE, some years ago. Here's the example I mentioned then. So the carrying amount, which is the net book, I call the net book value, for the vehicle is 65,000. The vehicle is recoverable, has a recoverable 50,000. So the answer for this one, if you think about it, this is the impairment. So the impairment of IAS 36. I'm just going to, you now know that. I'm just going to comment on the numbers. What does it mean? You need to. You just get the feeling that they might give you a little calculation for these, because as soon as people, I think, students see the names, that you just get lost. You just actually forget what they mean. So the carrying amount is the net book value, and £65,000 is given. Well, think of that as being the balance sheet value now. But this £50,000 is recoverable. Well, this is after the reassessment. So at the end of the financial year, after depreciating for this year as well, we now get £65,000 for this asset, this delivery vehicle. And after this reassessment, it's been determined that 65,000 is actually too high. So maybe the depreciation has been generally fine. It's been okay. But for £15,000 difference, then that is an impairment loss. The difference between the recovery amount and the carrying amount is 15,000. That is an impairment loss. And that obviously, what would happen then is £50,000 will go on the balance sheet instead of the 65 at the recoverable amount, and the 15,000 impairment loss will go as expense in the P&L, or the statement of comprehensive income. So it's an interesting element. You just need to be aware of the terms. So look at a few examples. Again, there's a couple I think in the QA book which are reasonable. I don't think they're exam standard. But maybe you wouldn't get them. I don't really think it's an exam topic, but certainly you might get a little. I don't know why not? Why not have this kind of question and then do a little few calculations? It's interesting to kind of speculate. 3. 1st of January, PP was revalued from a net book value of 2 million to 2.5. So that's an increase in the value. The revaluation has not been included in the company's books. Non-current assets are generally depreciated by 2%. But no depreciation has been charged in the year. So all that, what is all that talking about? It's talking about PPE, it's talking about depreciating, it's talking about revaluation. So the whole element there, all of them parts come together in PPE. So IAS 16. So again, all of that there will be IAS 16. Quite straightforward, I think. Anything like in the previous one to kind of differentiate between these. Nothing there about carrying amounts or potentially an incorrect value on the balance sheet or an inflated value in the balance sheet, which is what we just had. So definitely IAS 16. 4. No allowance is made for irrecoverable debts. The directors feel that 3% of trade receivables debtors would be appropriate. So the clue is underlined. Allowance is the new word, or a new word. You don't have to use it, but it's the new word for provision. It's used because if they mention provision, which they can do that. If they mention provision, it's a bit obvious. So which has provision stated in the title? Well, it's IAS 37, isn't it? So a provision for irrecoverable debt, which is bad debts. So you got IAS 37, provisions, contingent liabilities, and contingent assets. Last one. The directors of Grodlin plc have valued all closing inventory at cost. Included in the value of the closing stock was 10 damaged cookers. They've been damaged. They cost £20. Normally sell for £50. The damaged microwave cookers could be sold for £30 each after the necessary repairs. That's all NRV, isn't it? Yeah, NRV, total cost of repairing and so on. So all that is talking about finding the correct value for inventory. So it's got to be IAS 2, inventories. Again, that was given, but it didn't ask for a calculation. But you could easily work out there the value to go into the balance sheet, cost of NRV. So whichever is the lowest, that's the rule. But it wanted the IAS and the name. Okay, so hopefully you find that useful. Quite a lot of examples there. I think you do learn. I think it is true. You do learn a lot from examples. You try and look over those again. Try and pick out the key phrases, the key points from that to relate it to an IAS. And then once you've done that, you become more familiar with it. You can then go back to the theory of each of the IAS that you need to know, and then try and just revamp, kind of revisit that in a little bit more detail. You don't need to know a lot of detail about these IAS standards at this level, even at A2, but you do need to know IAS 7, the statement of cash flows, in terms of the full layout and understanding the sections. I understand that it is a little bit unclear as to what the exam board means about how much is a basic awareness, but I suppose you get a feel from this from the past papers. The more past papers that we can look over and see, witness, then you get a feel for the kind of scope in the spec. So hopefully this has been of some use to you. Thank you for stopping by, and I'll see you next time for another podcast from Professor Accounting.